become a chartered accountant, you become the authority of numbers.
In that situation, the incoming asset or the incoming PP&E item, I can't recognize at fair value. It has to be recognized at carrying value of the asset given up.
So today we are going to discuss some more questions on debt valuation. So we'll look at some general questions moving into some detailed calculations as to how to do.
Therefore, when computing the value added tax, you should know, okay, this is exempt from VAT. Therefore,
You wouldn't believe me if I say this, but Honda made this bike not to sell. They initially made it for their employees to come to, in Japan, for their employees to come to work and then go home. So that is the first thing that you need to do when you classify an asset, non-current asset, as held for sale. Then what do is you apply the initial measurement requirement of SLFRS 5. What is the initial measurement requirement of SLFRS 5? SLFRS 5 says that on the initial measurement date, the asset has to be measured at lower of carrying value of the asset or the fair value less cost to sell. Fair value means what? Market value. Fair value less cost to sell. So carrying value, we know how much is the carrying value? 950. Fair value less cost to sell, I assume that to be 920. Then out of these two, which one is lower? Carrying value or the fair value less cost to sell? Fair value less cost to sell is lower. So how much is that? 920. What you need to do is immediately you need to recognize a fair value loss of how much? 30.
And what I want to highlight, three shift that is taking place in the corporate world, and that will help you to better understand the topic that we are talking now. These three shifts include, earlier we talked about you can run a company by only having money, but that is not enough. You need to have bundle of capital, right? Just because you have money, do you think you can make or build a successful business? You need to have brain, you need to have resources, and all of that bundle is required. So that is inclusive capital. And then earlier we talked about short-term share market, but now we talk about sustainable capital market. And third one, earlier in annual report, there are 500 pages, directors report, CEOs, various things, and nobody reads it. This story is disconnected. How do you put together as one story? And that is integrated reporting, right? Yeah.
So this is the value of the bond as at 18th of June 2018. You can see the formula again. We started with the value of the bond as at 1st April 2018, that is the starting point 907. Then I extrapolated that. I applied interest at 6% for 6 months period, but out of that 6-month period, you had only take the interest for 42.62%. Or out of 183 days, you have to take interest only for 78 days as a percentage, 42.62%. So that is what we had done. 907.05 into 1 plus 6% reduced by the applicable percentage. 1 plus 6%, we multiplied by 42.62% to take interest only for the applicable period. So then we calculate the value of the bond as 930.24. So
Going into the next step of now you know your risk, know how worse it is or how big it is or the type of return you are getting. Now beyond that, now how do I mitigate this? How do I use some tactics and reduce the amount of risk exposure I have? That's about diversification or using theories like portfolio theory to mitigate the risk. So that will be the last two components which will expect you to do certain calculations, interpretation based on calculations. So if you take this chapter alone, if I simplify it for you to understand, I will break this down into 5. First 3, understanding risk. Last 2 is about a calculation with the
Session outline of part 2 discussion. First one, VAT on importation of goods, section 2 and section 83. Why this VAT on importation goods are coming into picture? Because again due to the charging section. Under charging section, the section 2 subsection 1 in part B very clearly provided at the point of importation what should be chargeable, and if that imported goods, the supply of such imported goods are liable for the value added tax. Again, this is I am telling the continuation of the charging section, continuation of the discussion of the charging section. Why it is given in the importation. Importation is the point where VAT shall be chargeable. I think
Objectives need to be smart. If you don't have objectives that are smart, as you can see, smart, right? If it is not smart, it is unlikely that your organization will achieve these objectives, right? For example, your objectives have to be specific. S stands for specific. What do you actually need? Let's take a very simple example. Let's say that there is an athlete who is planning in the next Olympics to win a silver medal. This athlete is planning, he's a runner, sprinter, let's say, and is planning to win a silver medal. So what is the objective? Win a silver medal for the next Olympics. The objective is very specific, to the point. Silver medal, next Olympics, very clear. And when an organization sets an objective, it has to be measurable. If you can't measure, assign a numeric value. 15% profit target, reduction of labor turnover by 5%. See, those are measurable.